Are you paying too much for your property investment loans? Today, we're going to have a look and see if you are. Investment property loan rates, well, they are kind of just something that the bank comes up with. But there's also a number of factors behind that that determine what your interest rate's going to be. And my job is to help you understand that and get the cheapest possible interest rates for your investment property loans. There's a bit of a matrix behind that. So we're going to talk through how lenders set their rates and then how you can minimize the rate that you're going to pay. But why would you listen to me? For nearly the last 20 years, I've run a mortgage brokerage that specialized in getting loans for property investors. I have facilitated personally over $1.2 billion worth of property investment loans and home loans, and my team has facilitated over $3 billion worth of home and investment loans for our clients. So during that period of time, the lending landscape's definitely changed, and the information that you may have got 12 months ago, 2 years ago, 5 years ago is not necessarily relevant for today's property investor. So current benchmark rates. Where are rates sitting today? Look, it really depends whether you want a fixed rate or a variable rate. If you want a fixed rate, most banks have something from say 4.99%. If you're looking for a variable rate, then most banks have something from kind of 5.39. Now, why would you take a fixed in the current market? Well, at the moment, people think that we've probably got 2 interest rate reductions to go. Okay, so if you take 0.5% off the current variable rate, sits you just below the fixed rate. So some investors are now starting to opt to just bring that discount forward, maybe save themselves some time by investigating a fixed rate. Now, if you're like me and many others, you are really worried about your cash flow on your investment properties, especially when rates are kind of as high as they are. So a lot of investors are opting for interest only at the moment. So the current interest only rates on a fixed rate, believe it or not, actually started about 4.99. But if you're looking for variable rate interest only for investment, most of these are about 5.69%. Now, the reason why people lend or lean so heavily to considering interest only for their investment property loans is your return on investment is not actually the deposit that you put in, especially when you're dealing with 100% borrowings for your investment property. It is actually the contribution that you put into it over the year or years that you're calculating your return on investment. So therefore, the least amount of money you need to put into your investment, the better the return's going to be. Hence interest only, and hence why you want to make sure that your rate is as sharp as it possibly can be. Now, these rates that I've just discussed are probably the sharpest headline rates right now, but they may not be applicable for your particular situation. So what is the controlling factor that banks have when it comes to setting the investment property loan rates for their clients? It comes down to one word: risk. And that's what we're going to have a chat about next. What drives rates isn't just whatever the bank thinks that they want to offer, but it's all about their perceived risk, or the perceived risk that you're bringing to them. Think of it like this. If you were a bank and you had a pot of money to lend out to property investors or to people that want loans, how would you decide who gets the cheapest money and who gets the most expensive money? If you ran this bank, you would probably say, well, borrowers with bigger deposits get better rates. You would probably say borrowers with more equity get better rates, because the risk that client brings you is obviously far lower. You would probably also say clients that have higher debt servicing capabilities and lower debt to income ratios might get better rates as well, because they would have a lesser chance of default. You would also maybe say that borrowers from certain industries that have a high level of education, the people that participate in those industries have a lower chance of default statistically, might get better rates from your bank. So these might be people such as medical professionals, surgeons, anaesthetists, things like that. And you might say legal professionals, lawyers, solicitors, barristers might get better deals from your bank. You might say that those from accounting backgrounds might get better rates from your bank. So there's all of these kind of things that you would consider to be a more attractive borrower. Now, there's one category that you would also want to give better deals to, and they are all of the above, but belonging to your competitors. So therefore, new to bank borrowers that are in those special categories might get extra special rates, because not only are you getting the right type of client, but you're pinching it off one of your competitors as well. You might also give better rates to borrowers that are going to pay you a guaranteed amount of interest, such as borrowers that want a fixed rate, or borrowers that want to pay 1 year's worth of interest in advance. Because let me tell you, if someone's going to pay you a whole year's worth of interest in advance, the likelihood of them defaulting or getting behind on their loan is of course zero. So those borrowers, maybe you want to give them an extra 10 to 30 basis points discount off the rates that you might offer other borrowers. Now, with that same methodology, how would you flip that around? If you were controlling the bank, who would you charge higher rates to? You might charge higher rates to people that have incomes that rise and fall, such as those that have a high amount of commission or bonuses in their income, or seasonal income, or self-employed. Right? So all of these people might have a higher chance of default, therefore higher rate. Maybe it's harder to identify these people's incomes because of the way that their businesses are structured. So they need a low doc or a no doc type loan. Well, those people you would want to charge them a higher rate of interest. So when you hear someone bragging about their interest rate, you've got to remember that their interest rate isn't just about what they found online. It is a combination of what they found online, but also matched with their personal circumstances and their personal position to see what the bank is actually going to offer them as a client. Now, the next big thing is using your equity in order to secure investment properties, but also keeping an eye on your loan to value ratio. So this is a whole different section of how you can get better rates out of your current lenders or proposed lenders. Let's pretend you still ran that bank, and we were talking about, would you offer a better deal to clients that have more equity in the transaction or more equity in the property? Well, of course you would, right? So when you structure your loans, you want to be very vigilant and very focused on what your loan to value ratios are on all of your properties. If you're looking to extract equity from your home in order to be the deposit on the new property, we want to make sure that that deposit loan is potentially as small as it needs to be. Banks will quite often offer better rates if you have less than a 60% loan to value ratio or less than a 70% loan to value ratio when you're releasing equity from your owner occupied or an investment property for a future investment property. Then you have to think about, what is the desired loan to value ratio on the property that you're purchasing? Now, if you are obviously at an 80% loan to value ratio, that's probably the sweet spot, because you're getting a good amount of leverage, not paying any lender's mortgage insurance, and being able to borrow the money at a reasonable rate. But what if you need to push past that? What if there's just not enough equity in the other property to be able to balance that out? Is there any sweet spots there? Well, probably an 85% loan to value ratio is the next sweet spot. So if you miss 80, don't worry about 81, 82, 83, just jump straight to 85. Your loan to value ratio at 85 gives you a 1% lender's mortgage insurance, and with most lenders, there's a semi-reasonable rate on offer. After that, then we look at a 90% loan to value ratio, inclusive of lender's mortgage insurance. But you would expect to pay within that 10% difference. There's almost 3 different tiers of pricing, 80, 85, and 90. So it's all about getting a juggle between where you're extracting the equity and what you're purchasing, and getting that to line up to have the lowest possible borrowing cost for you. So with our investment property loans, what else should we watch out for? Obviously, headline interest rates and trying to minimize our interest rates are super important, but are they the be all and end all? Well, I think you also need to think about what your annual fees are. A lot of brokers and banks out there might suggest spreading your risk amongst 2 or 3 different lenders, but if that incurs 2 or 3 annual package fees, if you've got that spread over 3 different lenders at $395 per year per lender, that's $1,200. Well, there's no point saving 0.1% on your $1 million loans if you're going to pay that back to the bank in fees. So think about annual package fees. Think about construction loan fees. Some banks, if you're building your investment property, might be $300 in progress draws fees. Other banks might be $1,600 in progress draws fees. Think about application fees. Think about valuation fees. Think about loan establishment fees. Think about the bank's solicitors' fees. There's a whole heap of fees that banks and lenders can charge that might very well mitigate any interest rate savings that you're making. Now, these rates and fees don't always show up in the lender comparison charts, especially the bank's own solicitor settlement fees. So you really need to do a little bit of a deep dive and talk to someone who's going to give you a comprehensive list of what each lender is going to charge, and charge over maybe the first 2 or 3 year period, to get a hold on what your interest and borrowing costs are going to be. So, are you paying too much for your investment property loans? Now that we've had a look at the benchmark rates, and we know that we should be able to borrow the money somewhere between 4.99 and 5.69%, and we've had a look at how to structure your loans to minimize the risk or perceived risk to the lender to get a better rate. We've had a look at how to structure your loan to value ratios to get better rates from the lender and also reduce risk. And we've had a chat about the fees and charges associated with structuring your portfolio correctly with a bank. Do you think you've done it all correctly? If you want some more clarity about your portfolio and things that you could do and how you could save money, look, I've got a link below. Jump on there and set a time for us to meet, and we can run through all this. Look, don't worry about wasting time here. I do about 30 or 40 of these a week, so I'm more than happy to spend 20 minutes or half an hour with you to have a chat about your portfolio and how we could potentially help and get you moving forward. Don't forget to like, subscribe, share this content with any property investor friends that you might have, and I look forward to catching up with you next time.